The Trump administration has lifted sanctions on 3 Russian companies linked to a key ally of President Putin. This after Washington imposed a series of sanctions on Russian companies and individuals last April. Well, joining me now to discuss what this means for the Russian economy and its markets is Mike Harris, emerging market strategist and founder of Cribstone Strategic Macro. Mike, good to talk to you. Thanks indeed for coming in. I mean, the US has formally lifted sanctions on 3 companies linked to Oleg Deripaska, key ally of President Putin. How damaging have these sanctions been on the Russian economy?
Well, if we go back to the sanctions when they were initially imposed post-Crimea, they were meaningfully damaging to begin with. And clearly a lot of people think that they had quite a substantial impact on GDP over a number of years. But you could argue actually that the sanctions have left Putin a lot stronger, and the Russian economy was forced to undergo probably the biggest, most unheralded structural reform in all emerging markets because of those sanctions. Effectively, what has happened is that Russia is removed to a large degree its vulnerability to external forces. It's not there yet, but one of the things, if we go back a number of years, Russia was always fearful of freeing up the ruble, because they didn't know where that would lead. Would it lead to lines at the banks and dollarization? That was a key vulnerability of the Russian economy. But the end result of all this period of stress has been that the ruble is now a safety valve. And that's crucial. In other countries, when the currency goes, it leads to dramatic inflation. That's not an issue in Russia because it's an economy with deflationary tendencies. And because they've retained confidence in the ruble, they are ultimately, I think, on much sounder fundamental footing than most people realize. And relative to what U.S. expectations were at the time, they're probably quite frustrated that Putin is as strong as he is.
I want to get on to the Russian economy and to the ruble in just a minute in some more detail, but can we learn anything about the relationship between the Trump administration and Russia lifting these sanctions? Have we got any further on down the road of understanding what happened that brought all this about?
Well, I think this is more, they're treating this sort of as a bespoke exception because there was an engineering component to get them around. So it does show a lot of flexibility from the Trump administration to try and make this happen. And maybe because there were large listed companies with foreign investors involved, there was an element of lobbying as well from the domestic constituent base in the US. But this, in the end, we're still looking for more sanctions to be imposed associated with the Salisbury attacks. And that is something that, there's an indefinite time frame, but on balance, we're not out of the woods with sanctions at all. But relatively speaking, they seem to be going out of their way where they don't have to impose sanctions to try and avoid doing that. So the read across probably means they have an indefinite timeline associated with the new sanctions, as I understand. And that probably means that they aren't going to impose them at all.
On to the Russian economy. We are seeing inflationary pressures on the rise. You mentioned this briefly in an earlier answer. But the economy, of course, is still recovering from recession. How do you view the economy in Russia in the broad spectrum?
Well, Russia, when we think about a lot of the political sustainability of when a country is not democratic and the leader is dependent upon the system to stay in power, in certain countries, the economy is crucially important. In Russia, a recession doesn't mean higher unemployment because Russia has no demographic pressure effectively. So yes, there have been real wage declines, but unemployment is extremely low. So for a country coming out of recession, I think that's sub 5% unemployment is a really good starting point. So the Russian economy is not one that creates a lot of vulnerability for Putin, and he chooses his timing. When do I inflate a bit? And the catalyst for this higher inflation we've seen lately has been an increase in VAT from 18 to 20%. And there's also been the extension of the number of years you have to work to retain your pension. So actually post the election, we are seeing what investors like to see in a lot of markets are fundamental reforms that help to rebalance and improve the longer-term outlook for the economy. Putin, more than most, can get away with this because he feels that he is pretty invincible from a domestic political perspective.
One of the big income factors on the balance sheet, of course, for Russia is the oil market. Oil's well off the highs that we saw towards the late last year, but we're off the lows. Now, how is the Russian economy, or how's the balance sheet in the Russian economy looking with oil at these levels? Would it like to see higher oil prices, or is it happy just producing more oil?
Well, I mean, we're seeing this Moscow-esque in a sense, this coordination between OPEC and Moscow, and there are some cuts. So in one sense, they're effectively saying, usually they were always trying to produce as much as they could and let the price be where it was set otherwise. Now they are contributing to this more finely balanced market. Broadly speaking, they're fine at the current oil price. These reforms that they're pushing through, fundamentally Russia is very vulnerable to a collapse in oil prices because they haven't figured out a mechanism to tax more of the economy. So the increase in VAT is important, the pension adjustment is important, but relatively speaking, they're still overly dependent upon the energy complex for taxation. But because the ruble was the safety valve, that's why at this oil price, they're still in good shape. If the ruble was as strong as it was and had they defended it, the budget implications of the current oil price would be quite negative. So they're quite balanced. And relatively speaking, I mean, a lot of what we saw, I think, in the fall were the geopolitics hitting the oil price. Yes, there was a little bit of demand, but you had Saudi guilt, and you had the fact that the U.S. Did not impose the zero definition effectively in terms of what you could import from Iran only at the last minute. Both of those came together and created a little bit of market excessive adjustment. I think on balance, we're at a stage where supply can adjust to demand unless demand really were to fall quite substantially. So relatively speaking, oil is probably one of the positives for the Russian story in 2019.
Yeah, I want to follow up on the ruble point of your answer as well. It was on the back foot for much of 2018, although this year it started to appreciate once again. How does the ruble compare amongst other emerging market peers?
Well, it's not as how could I say, the proxy for emerging markets, because there are other drivers as opposed to risk appetite. So when people want to turn against emerging markets, they'll go after the rand for two reasons. One, because it's large and liquid, and it is a current account deficit country, unlike Russia. And secondly, because they know the central bank will never respond to rand weakness. So it provides a good playground effectively for emerging market investors. The ruble is a little more bespoke because there are trends associated with the current account, policy decisions associated whether they're buying FX or selling, and the interest rate dynamic. The central bank has been relatively hawkish throughout this cycle despite broader deflationary tendencies. So, if you were to say from a risk-reward perspective, you have confidence in the central bank, you're reasonably comfortable with oil, you know the pickup in inflation has largely been just because of VAT increases, which is a structural positive. They've increased the pension age. Putin's political cycle seems to be working in his favor right now. I would have thought the risk-reward for the ruble, when you're getting an 8% yield and the Fed is now pausing, is pretty good.
I want to move on to the equity markets if I can, because I think since the start of 2018, the Russian benchmark equity index has gained nearly 20% versus the MSCI emerging market index, which I think is down by a margin of 12%. What's been driving the outperformance of the Russian equity market?
Well, relatively speaking, Russia is beating, as I'd said, partially because of what had happened with the sanctions, the way they adjusted to, the ruble had adjusted in advance of a lot of emerging currencies. You have the central bank credibility. It's not a playground for global investors when it comes to taking a view on emerging markets. So it missed a lot of that turbulence associated with the weakest links in emerging markets, because actually Russia is in much stronger fundamental footing. So I think what we've seen in the last year has been a reflection of what I was trying to articulate, of Russia getting through this in much stronger positioning, because that structural reform of creating your currency as a safety valve and not having inflationary pressure of any meaningful extent on the back of that is a huge point of differentiation in emerging markets. So you're buying Russia more now for news flow associated with sanctions, and for value on the view that over time people get more and more comfortable with the market.
Away from Russia, but including Russia in the emerging market spectrum, where is the keen money going, following which economy is going to do best and which currency we should be following within the emerging market space?
Yeah, I mean, we've seen emerging obviously bounce nicely so far this year, and people always love bespoke stories. You know, when Modi first comes in, people rush into India. Now we're in a place where a lot of people are paying attention. Brazil's doing extremely well because there is a Thatcher-esque sort of leader. And to the extent that that plays through, it could be quite dramatic, because Brazil is in need of reforms. It's not a country that can live with the status quo. And you have a leader who, and investors do not care about democratic shades of gray. So you'll have some angst associated with a lot of his Bolsonaro's some policies from a social perspective. Unless that leads to instability, which there's no reason to expect it would, the markets only focus on economic policy and his ability to get that through, and a strong leader, unless he runs into the gridlock that Trump has run into. But even with Trump, you see on specific issues you can create unity that allows them to move forward. So the market's embrace of Brazil right now seems very logical. But more importantly, the S&P has been turbocharged for quite a while, not just because the U.S. was firing on all cylinders relative to most economies, but also you had the tax benefits last year. So now earnings growth in the S&P most likely is going to be single digits. So even as long as we're risk tolerant, because what emerging markets don't like is when there's a flight to safety. Okay, so if we can avoid that, which it looks like we can, the Fed's on pause. Relatively speaking, the attractions of the S&P with this likelihood of more earnings downgrades, let's say, than upgrades, probably should mean this is the ideal year to shift from the S&P into emerging markets, because you know emerging markets are cheap. If what I said about oil earlier makes sense, then they'll benefit from that broader embrace of the commodity complex. I'm a big believer that this is the year of rotation into emerging markets, unless you get recessionary fears in the U.S., which I don't expect. So one caveat to that, though, of course, is that for a long time, everyone thought that as the U.S. hikes rates, that strengthens the dollar. But that didn't work for a lot of times because you couldn't own the long bond in the U.S. because it was so disproportionately priced because of QE. And everyone knew that Fed hiking was going to push the long bond higher. So strangely, now that the Fed is done hiking, it could actually lead the dollar to strengthen because people can aggressively play the U.S. long bond. That's a huge liquid market. So right now we're adjusting to the typical story that everyone expects. Fed done, dollar weakens a bit, the carry traders sort of move away. But more fundamentally, this could lead to inflows into the dollar. So I would just keep that in mind, as that's probably the most likely thing to disturb emerging markets, but the markets don't believe in that thesis. So until it starts to happen, go aggressive into emerging markets, play this switch from S&P into emerging, and if you start to see the dollar is just ticking up quite persistently, which I wouldn't totally exclude as a possibility, that's when you have to say, okay, I got to retrench back into the U.S.
Okay, Mike, look, it's a pleasure. Thanks indeed for joining us with this roundup of some of the news from the emerging markets, with a special emphasis there on the Russian economy. That's Mike Harris, emerging market strategist and founder of Cribstone Strategic Macro.